Public Finance in India, Part 3. Third, Canon of Convenience. According to this canon, every tax should be levied in such a manner and at such a time that it becomes convenient to the taxpayer. Fourth, Canon of Economy. According to this canon, the cost of tax collection should be the minimum. If a major portion of the tax proceeds is spent on the tax collection itself, then such a tax cannot be considered as a good tax. Types of taxes. There are two main types of taxes. They are direct tax and indirect tax. Let us study in details. First, direct tax. It is paid by the taxpayer on his income and property. The burden of tax is borne by the person on whom it is levied, as he cannot transfer the burden of the tax to others. Impact and incidence of direct tax falls on the same person. For example, personal income tax, wealth tax, etc. Second, indirect tax. It is levied on goods or services. It is paid at the time of production or sale and purchase of a commodity or a service. The burden of an indirect tax can be shifted by the taxpayer to other persons. Hence, impact and incidence of tax are on different heads. For example, newly implemented goods and services tax (GST) in India has replaced almost all indirect taxes and custom duty. Do you know? Direct taxes are further classified into three categories depending upon the rate of tax. These are: first, proportionate tax. When a tax is levied at the same and constant rate on all incomes, it is called proportional tax. Second, progressive tax. A tax, the rate of which increases with every increase in income, is called progressive tax. In India, we have progressive tax rate system. Third, regressive tax. In regressive taxation, the larger the income of a taxpayer, the smaller is the proportion of the tax levied on him. B. Non-tax revenue sources. Public revenue received by the government administration, public enterprises, gifts and grants, etc. are called as non-tax revenue. These sources are different than the taxes. A brief information about these sources are as follows. First, fees. A tax is paid compulsorily without any return service, whereas fee is paid in return for certain specific services rendered by the government. For example, education fee, registration fee, etc. Second, prices of public goods and services. Modern governments sell various types of commodities and services to the citizens. A price is a payment made by the citizen to the government for the goods and services sold to them. For example, railway fares, postal charges, etc. Third, special assessment. The payment made by the citizen of a particular locality in exchange for certain special facilities given to them by the authorities is known as special assessment. For example, local bodies can levy a special tax on the residents of a particular area where extra special facilities of roads, energy, water supply, etc. are provided. Fourth, fines and penalties. The government imposes fines and penalties on those who violate the laws of the country. The objective of the imposition of fines and penalties is not to earn income, but to discourage the citizens from violating the laws framed by the government. For example, fines for violating traffic rules. However, the income from these sources is small. Fifth, gifts, grants and donations. The government may also earn some income in the form of gifts by the citizens and others. The government may also receive grants from the foreign government and institution for general and specific purposes. Foreign aid has become an important source of development finance for a developing country like India. However, this source of revenue is uncertain in nature. Sixth, special levies. This is levied on those commodities the consumption of which is harmful to the health and well-being of the citizens. Like fines and penalties, the objective is not to earn income but to discourage the consumption of harmful commodities by the citizens. For example, duties levied on wine, opium, and other intoxicants. Seventh, borrowings. The government can borrow from the people in the form of deposits, bonds, etc. It also gets loans from foreign governments and organizations such as IMF, World Bank, etc. Loans are becoming more and more popular source of revenue for the government in the modern times. Do you know? Goods and Services Tax (GST). The Goods and Services Tax (GST) came into effect in India on July 1, 2017. It was proposed by the Kelkar Task Force on Implementation of the Fiscal Responsibility and Budget Management (FRBM) Act in July 2004. The 101st Amendment in the Constitution Act 2016 provided for the constitution of the Goods and Services Tax Council (GSTC), comprising the Union Finance Minister, the Minister of State, and the finance ministers of each state, empowering the council to make recommendations on the GST rates, exemptions, thresholds of the tax, etc. GST is different from an excise or sales tax imposed on a single state levy on manufacture or sale of a product. It is a comprehensive tax base with nationwide coverage of goods and service. GST would replace the following taxes levied and collected by the center and states, such as central excise duty, service tax, additional duties of customs, state value added tax, entry tax, entertainment tax, etc.